And the stock market is opening in the red this morning after a rough finish last week on a weaker than expected jobs report. The Dow's down more than 1,000 points as that global sell-off intensifies. Chief Business and Economics correspondent Rebecca Jarvis joins me now for more. Rebecca, how significant is this slide and what does it mean for the average investor?
Well, it is a significant slide, no doubt. The Dow that you're looking at right now is down 2.6%. Tech stocks, the Nasdaq and the S&P 500 are down even more than that. And the S&P 500 generally is what's inside of people's retirement savings accounts. I just want to point out, however, that just a few weeks ago, all the markets were at record highs, and it's important to think about what caused this. Overnight, Japan's Nikkei plunged 12%. That is its worst day since 1987. That's Black Monday's crash. And investors are responding to Friday's stock declines and weak jobs report here as well. Employers added just 114,000 jobs in July. That was well below the 185,000 forecast, and the unemployment rate jumped to 4.3%, which is still very low. That is historically low joblessness, but it does show that joblessness has increased more than 0.5% since January, when unemployment was 3.7%. And that's just, Diane, something that doesn't usually happen when the economy is healthy. A rise like that is historically a sign that a recession is imminent. I want to point out one other area of weakness in our markets today, and that is the tech stocks. I said the Nasdaq, things like Apple and Nvidia, companies that were really relying on AI, on the artificial intelligence trade. Those are some of the hardest hit today. And when you put this whole thing together, it really signals that a rate cut is coming in September or maybe even earlier. The Fed meets again in September, but there are calls now that maybe the Fed, in its fight against inflation, which is still higher than they'd like it to be, but much, much lower than it was a year ago, that the Fed, it's time now to really focus on the economy, on jobs, as we see some of this joblessness creeping higher, to then cut interest rates, which is great news for people if they are carrying a credit card, for example, because then you see those APRs go down. And it could be decent news also if you're trying to buy a house or a car, because that means you might be able to get a mortgage or a car loan for less than what we've been seeing it for the last year, Diane.
And Rebecca, this sell-off now is also fueling some conversations that maybe the Fed should have cut rates sooner. What's the crux of that debate?
Well, you're always going to hear the Fed, the Monday morning quarterbacking of the Fed. So what's going on right now is that rates are now steady. They've been between 5.25% and 5.5% for some time. The Fed continuously tells us, as they did last week at their last meeting, that they're looking at the data, that it is data dependent. So things like, where is inflation trending? Where is the jobs market trending? And where Wall Street is in those calls, the people who are saying the Fed should have already cut, they're looking at Friday's jobs report and they're saying, wait a minute, a jobs report where there's only 114,000 jobs added, when we'd like to see something more like 180, 200,000 jobs added in a month, and we'd like to see unemployment not trending so much rapidly higher. That's where people will say, well, the Fed should have already cut. Now, the Fed can cut. The Fed can cut tomorrow if the Fed wants to cut tomorrow, but they're going to continue to look at the data. It's most likely that they will cut definitely in September and perhaps sometime earlier in August.
All right, Chief Business and Economics correspondent Rebecca Jarvis, thank you.